Welcome to Paycheck for Life, Sarah's new and mid-career employee webinar. So in this webinar, we are assuming that you're either new or you are somewhere in the middle of your career. That's why we call it new and mid-career employee webinar. The bottom line there is that you're not yet near retirement, which is actually a good thing in this context because it means that you have plenty of time to do that retirement planning that you're going to need to do, and that I'll walk you through during the presentation. So in this seminar, I'm going to tell you all the things that you might want to know about doing that planning. And since you're curious enough already about retirement planning to watch this presentation, you probably have some questions. Questions like, what do I need to know about my pension? Do I need to do anything? And if I need to do anything, what do I need to do? Well, I kind of already know probably 95% of the questions that you're going to ask. So I've already arranged the answers to your questions that I'm projecting into the form of this checklist that we'll go through during the presentation. So I'm going to help you understand a few retirement basics about your Acera membership. As part of that discussion, we'll talk a little bit about understanding some pension math. I'm not going to bog you down with a whole bunch of stuff. I just want to introduce you to our retirement formula, and that's going to help you do that retirement planning for the future if you know how the formula works. We'll also talk about purchasing service credit with Acera as part of that discussion. Then I'll help you get a pension estimate. So we'll take a little peek into the future about what you can expect to receive from Acera once you retire. I will help you understand retirement eligibility. That's when you can actually first retire if you choose. I'll help you understand some additional benefits that we offer, like healthcare benefits and death benefits. I'll help you designate your beneficiary or beneficiaries for the Acera death benefits to make sure your family members are taken care of. And then we'll talk about career planning options. And what I mean by that is what happens regarding your Acera membership in the future when you leave your job? Like, what are your options regarding your retirement? So I'll take you through kind of three options for that. And then we'll get into making a retirement planning picture. And what I mean by that is that we'll take a peek into the future and we'll look at your possible retirement income when you retire in the future. And I'm going to make sure that we get you on a trajectory where you have adequate income in retirement to actually go ahead and retire and live a comfortable life. And then as part of that discussion, we'll talk about starting a 457B account. So let's jump right in. Let me help you understand some retirement basics first off. So who is Acera? Acera, in one sense, is this acronym that stands for the Alameda County Employees Retirement Association. But Acera is actually made up of a lot of people. There's about 93 of us that work here. We're all Alameda County employees, like many of you. And our entire job is to provide retirement, disability, and death benefits to our members. Members of Acera, that's you. You are a member of Acera. So you're part of the who that is Acera. And you're a member of Acera because of the position that you work and who you work for. So you work currently, or at some point in the past, you worked full-time in a retirement eligible position. So you're currently in that retirement eligible position. Um, and that automatically made you an Acera member when you are in that working in that position for one of our 6 participating employers. So these are the 6 public agencies in Alameda County that use Acera to provide retirement benefits to their employees. So if you work in one of these places in that retirement eligible position, and to get in that retirement eligible position, you had to at least start out full time, that automatically made you an Acera member. And your membership is mandatory. So it's automatic and mandatory. And as an Acera member, you pay contributions into Acera's retirement fund with every paycheck. So if you look at your pay stub in the before tax deductions column, you'll see a line that says retirement, and maybe it gives you some more information. And you see some money coming out of your paycheck on a pre-tax basis, and that goes into Acera's fund. And every time you pay into Acera's fund with every paycheck, your employer is also contributing on your behalf. So you're contributing to Acera's fund, your employer is putting money in on your behalf. So what do we do with that money? Well, we don't want that money to just sit around and collect dust and lose ground to interest. So we invest that money in a diverse array of investments all over the world, and we over long periods of time, we earn a lot of interest on that money that we invested. So that's why the arrow goes both ways. We're investing the money and we're seeing returns back to Acera's fund on the money that we've invested. So this is really three sources of income for this pot of money that we call Acera's fund. Okay, so why are we collecting all this money? What are we going to do with it in the future? Okay, so you, as a public employee in that retirement eligible position, working for one of six of Acera's participating employers, as you go out through your career and as you work more, you earn more and more credit toward retirement. And you earn credit toward retirement in three different categories, which I'll show you in just a minute when I talk about the retirement formula. But the longer you work, essentially, the more and more credit you're earning toward retirement. And the reason you're doing that is because at some point in the future, you're going to stop working at your job and you're going to retire from Acera. And at that point, you stop earning credit toward retirement and you start collecting on the retirement that you've earned throughout your career in the form of this monthly retirement allowance for life. You're going to get a check from Acera. Really, it's direct deposit every month on the last business day of the month for the rest of your life. You cannot outlive your Acera retirement. It is a very special thing. It works totally different from like a 401k, where that's a finite amount of money that can run out. Pensions are special. So Acera is a defined benefit pension plan. It's guaranteed income for life that you can plan on. So the part about it, the guaranteed income is the monthly retirement allowance for life. The part about it being something that you can plan on is it's defined by a formula that is predictable. So I'll show you in this presentation how you can get a very precise estimate on what your retirement allowance is going to be. And that helps you plan for retirement very accurately. That's one of the ways that pensions are special. The other way is that everything that you pay into Acera's fund throughout your entire career, you work 20, 25, 30 years, you're paying into the fund with every paycheck. We're also paying interest to your employee contribution account whenever the fund earns interest. We're going to give you all that money back within your first 3 to 5 retired years. And then everything after that first 3 to 5 years, let's say you live another 15, 20, 25, 30, 35 years, 40 years, whatever, after your retirement, it's it's almost like this amazing bonus that you get because you've already gotten everything you've contributed back. But really, that's just the way the system works. The employer contributions help with that, but mostly it's the investment earnings because we are professionally investing our $12 billion fund on a group basis to earn, as much interest as we possibly can, mitigating risk. And it's the interest that pays for 3/4 of your lifetime pension. Okay, so that's kind of the initial stuff about how Acera works and how your membership works. Let me give you a little bit of context for some of the discussions that we're going to have about kind of the nuts and bolts of how Acera works regarding some milestones you're going to see with your membership with Acera. Okay, so this will help illuminate some things that we're going to talk about, and it will help you understand some different pieces of pension lingo that you'll hear throughout your career. Okay, so here are your pension milestones that you can expect with your membership with Acera. Okay, you have your date of hire. This is your first day of work in your retirement eligible position. Then you have, for 4 of our 6 employers, a 2-week lag time. Your first day of your second pay period is your date of entry into Acera. And like I said, it happens automatically. So this is your first day of Acera membership. This is when you start earning credit toward retirement with Acera. But for 2 of our employers, Livermore Area Recreation Park District and the Housing Authority, there's no 2-week lag time. Your date of hire into the full-time retirement eligible position is your first day of Acera membership. Okay, now you're an Acera member. One of the 3 ways that you earn credit toward retirement is simply by the time worked, and known as service credit. So you work, let's say, 5 full-time years or the equivalent of 5 full-time years, you become vested in Acera, invested in the retirement system. Vesting is kind of a loose concept. It kind of means guaranteed. Once you're vested, you start being able to access the guaranteed benefits. Like you reach some kind of eligibility requirements to being accessing the guaranteed benefits. And that happens with 5 years of service credit. Okay. So then after that, at some point in the future, through some combination of your years of service credit and age, and it's There's a few different combinations that'll get you there. You become eligible to retire, and I'll show you what those combinations are a little bit later. But this is the first day that you could physically retire from a SARA if you choose. But you don't have to, and many people do not. And many people work past their first retirement eligibility date to earn more and more credit toward retirement to increase that monthly retirement allowance by the time they retire. Okay, the next milestone is the day that you stop working. So this is your termination date, the date that is your last date on payroll for your employer. This is the day that you stop earning credit toward retirement. But you're going to earn credit all the way up to the last 15 minutes of that day that is your last day on payroll because while your service credit is measured in years, we calculate it down to the fraction of a day. And if you look at your service credit number, if you log into your account on our website, you'll see your service credit will say like, if you've worked 7+ years already, it'll say like 7.65234. And all those decimal places are as keeping track of your service credit down to the fraction of a day. And you will get all of that credit when we calculate your retirement. And I'll show you that in a few minutes. Next milestone on the chart is your retirement date. This is a date that you choose. And I've kind of overlapped these here because many people will work all the way up till their retirement date and go straight from active work into retirement with no gap in time there. Um, sometimes people don't, and that's called becoming a deferred member, where you stop working and you defer your retirement to a later date. You don't retire from a SARA immediately. And I will tell you all about that when I talk about your retirement options, choosing, I'm sorry, doing that career planning in the second half of the presentation. Okay, so once you retire, this is when you start collecting the retirement that you've earned, and you're going to collect it every month for the rest of your life until your death. That's when your retirement payments stop. But there's one more milestone on the chart, which is that at the time of retirement, you can name a beneficiary for monthly continuing payments after your death. That's called a continuance. And most of the time, it will happen for the rest of your beneficiary's life. And so at the death of your beneficiary is when those continuance payments would stop. And that would conclude a SARA paying out all the benefits that we owe you and your beneficiaries. Okay, next topic. And before I do that, I see a question popped up. So let me answer this question. Question is, how is a SARA protected from the massive market shifts we are in, and what protections does a SARA have in this moment of economic downturn and threats to our basic structures? Excellent question. So our main lever for mitigating risk is having a diverse array of investments. If you're curious about what we invest in, you can go out to the web and you can go under About a SARA and go under investments here. And if you look at current investment portfolio, you can see our asset allocation. So we're not just in stocks. The stock market has not been performing great thus far this year. We're in a diverse array of investments. And so we have, being a $12 billion fund, we have access to the best experts. We have professional investment consultants that we hire. We have a board of retirement who are all fiduciaries. And we have a professional investment department at Acera. So some of Acera staff are part of our investment department. And so we have all these experts, managing our risk with the goal of maximizing our returns, but mitigating risk. And mostly the way that we are able to mitigate this is through long-term strategy. So in the short term, markets go up and down, but over the long term, markets tend to go up. And so we take a long-term approach, and we have an entire investment strategy geared toward that. And so that's kind of the answer to that. Okay, let's see here. Okay, there is a question about beneficiaries and the continuance. The beneficiary upon the death of the Acera member gets the same amount as the Acera member until the beneficiary passes away. Well, it depends on which of the 5 retirement options you select at the time of retirement, which we're not going to talk about during this presentation. But Um, in some cases, that can be the case, and that can be the case should you pass away before retirement. I will tell you about your beneficiary's options should you pass away before retirement when I talk about the death benefits in the second half of the presentation. Okay, so sticking with kind of the pension basics, your membership. I mentioned just to say a couple more words about vesting. I mentioned that vesting means guaranteed. The guarantee comes from state law. So state law tells us how to calculate your retirement, how to collect contributions. It tells us how to manage a SARA and administrate a SARA. So everything is done according to state law, and you are guaranteed your retirement under state law. And the guaranteed benefits are the retirement allowance for life, an annual cost of living increase to your ASERA monthly retirement allowance for life, um, and a $1,000 lump sum death benefit. And there are some other death benefits, including continuance payments, which I'll talk about in the second half of the presentation. One more thing that I want to mention here, just as an aside, is within pension lingo, there's a lot of synonyms for this idea of the monthly retirement allowance. Some things that you'll hear me say will probably be a retirement allowance, retirement benefit, pension benefit, pension allowance. These are all synonyms for this same concept of the monthly retirement allowance for life, just so you don't get confused. Okay, let me tell you about your tier. You're all in one of these tiers, and it's based on your date of entry into a SARA. So, first off, which timeline are you going to look at? If you're a safety member, you're going to look at the bottom timeline. Safety members are sheriff's deputies and probation officers, and there could be some other sworn officers in there that I'm not aware of. If you're not a safety member, you're a general member. So you're looking at the top timeline. Unless you're a general member who works for the Housing Authority or a general member who works for Livermore Area Recreation and Park District, then you're looking at the timeline for your employer. The way it works is that if you entered a SARA before the cutoff date for the tier, that puts you in the earlier tier. So if you entered a SARA before July 1st, 1983, you would have gone into tier 1 as a general member. If you entered a SARA July 1st, 1983, all the way up to December 31st, 2012, that would have put you in tier 2. If you entered a SARA January 1st, 2013 and beyond, that would put you in tier 4 in all cases. You'll notice the Housing Authority has a different tier 1 cutoff. LARPD doesn't have a tier 2, they have a tier 3, and they have a different tier 1 cutoff. And safety members have 3 tier 2s. And if you're a safety member, you entered during this period, you had a choice between the 2 tier 2s. And if you didn't make the choice, you were defaulted within that first 45 days of your safety membership into one of the tiers. Now, in any case, if you don't remember your date of entry or you don't know what tier you're in, what you can do is log into your account on our website. Do I have a screenshot of that? No, but I'll show it to you out on the web. You go to acera.org, acera.org. On every page, there's a login button here. You click login. Okay. If you've never done this before, you're going to have to enroll first. Okay. So you're going to click the enroll button. And then to enroll, you're going to need an enrollment PIN. So you're going to request an enrollment PIN. You put in your info here, you hit request PIN. And then what we're going to do to keep things extra secure is we're going to send you a letter in the mail with your PIN. So it will take a few days for you to receive that. And once you do that, you can come back to the screen, put your enrollment PIN and finish your enrollment. We just do that for extra security. So it does take a few days. We did send everyone a PIN in the mail back in all the active members. We sent a PIN in November, but it already expired, that PIN. So you can request a new PIN here. It expires in 90 days. So that's how you do that. And then once you get in there, you can see your tier, you can see your date of entry, you can see a lot of other pension data for you, and you can use our benefit estimator tool, which I'll show you some screenshots of in a little bit. Okay, I see some questions popping up. Okay, questions. Let's see. Does my Acera online account balance include my employer's contribution or just my contributions? Just your contributions. It's possible. I can't remember how they have it set up these days where if you can see the employer contributions, if you can see them, it doesn't even matter because you can never get a refund of the employer contributions. The only way that you take advantage of the employer contributions is by retiring from a SERA and drawing the lifetime pension. Otherwise, the employer contributions always stay with the fund. Okay, somebody is asking regarding tier. If you were an Acera member 15 years ago, you left. It sounds like you took a refund of your contribution account at that time, and then you come back and re-enter Acera. And you used to be in tier two. Could you re-enter as tier two? You cannot, because you are going to re-enter as tier four because you had canceled, you had taken a withdrawal. But you can buy back that time, redeposit that money, which I'll talk about. But that would put you in tier four. Okay, next question. Or if you came back after um, what was it? July 1st, January 1st, 2013. That would put you in tier four. Okay, and let's see here. If you come from another California public retirement agency with more than 10 years, are you automatically vested in a SERA? Yes. And that if you establish reciprocity between the systems. And I will tell you about reciprocity in the second half of the presentation. Reciprocity is linking different California retirement systems together to synergize your membership between those systems. And that is one of the benefits of that synergy is that the service credit that you earn under all of the systems gets you over the vesting and retirement eligibility requirements among all of the systems. And coming in with reciprocity could put you in an earlier tier. It would be based on your date of entry into the earliest system that you linked together. If you want more information about that, if you go to acera.org/tier, TIER, there's more information about that. Okay, so I'm going to show you this slide right now, and this is going to provide some context for this greater discussion that we're having today. Um, in retirement, thinking way into the future when you retire, in retirement, you're going to need income to pay for your life. And your income is going to come from a few different sources. It's going to come from your Acera monthly pension. Uh, in the future, when should you retire from Acera? If you have any other pensions, you could kind of consider that as the same category. So pension income. Okay, Social Security. In the future, when you reach a certain age and you retire, you can start drawing payments from the federal government Social Security system. That's another source of retirement income. Okay, and then anything beyond your pension income and your Social Security income is going to come from your own personal savings and investments that you have saved and invested throughout your life up to retirement. So that's kind of the whole picture of the places that your retirement income can come from. And financial planners will tell you that you're going to need 80% of whatever you were making while you were working. You're going to need at least 80% of that income to maintain your standard of living in retirement. Okay. So that's why you're kind of seeing us add up these three sources of income to equal at least 80%. Okay. Now, if you're brand new and you don't have any retirement savings and you've just started earning credit toward your Sarah monthly pension, you might be wondering how you're going to get there. It's actually pretty easy to get pointed in the trajectory of having 80% income replacement, and I'll show you exactly how to do it in the second half of the presentation. So I wanted to show you this slide to give you some context. We're going to talk a lot about the Acera monthly pension first off, and then I'll come back to this slide and we'll talk about Social Security and additional savings and investments to get you pointed in that 80% income replacement trajectory. So regarding the Acera discussion, let me help you understand some pension math, okay? Some of you are allergic to math. When you see that word, it's not your favorite, but don't worry, it's not complicated, okay? This is the extent of it. It's one multiplication, and I'm going to walk you through this. And you might be wondering at this point, okay, I just started. I'm new, or, I'm in the middle of my career. I'm not going to retire for another 10, 15, 20, 25 years. Why do I need to know this now? Okay, why are you taking the time to explain this to me now? The reason is because what I want you to understand is how to maximize this monthly retirement allowance for life. And you do it by maximizing these three factors in the multiplication, and I'll show you exactly how to do that. Okay, right now. And if you understand how to do that, as you go through your career, you'll really understand, okay, I know how to receive the maximum monthly pension from a Sarah, because there's not a lot of levers that you have, or little dials that you have to be able to dial this in, but you do have a few, and I'll show you what they are. Okay, so let me walk you through this. When you go to retire, think about the far future when you retire from a Sarah. A Sarah is going to do this calculation for you that's going to determine your monthly retirement allowance for life. You are going to get, as your monthly retirement allowance, a percentage of your highest salary that you made from any point in your career for each individual year of service that you work, each individual year of service credit that you earn with a Sarah. Okay? So this sentence is telling you in English what this multiplication is doing. So let me plug in some numbers and walk you through it. Okay, let's say that the percentage, just to give you an example, let's say that the percentage of your highest salary that you are going to get for each year of service in retirement is 2%. Okay, and let's say also, let's imagine that throughout your career, you earned exactly 20 years of service credit with Acera by working 20 full-time years, or the equivalent of 20 full-time years, okay? So let's say you earned 20 years of service credit. Now, what the sentence is telling you is you're going to get 2% of your highest salary for each individual one of those 20 years of service. So essentially, we're taking 2% and we're adding it up 20 times. You're going to get 2% plus 2% plus 2% for each one of those 20 years. Essentially, we're multiplying them together. 2% times 20 is 40%. Okay? So that means that your retirement allowance is going to be 40% of your highest average monthly salary. So then to finish out the example, let's say your highest average monthly salary that you were earning while you were working is $5,000 per month. So you can see that your monthly retirement allowance is going to be 40% of $5,000. We finish multiplying it out, it's $2,000. So this is what we would pay you every month for the rest of your life. So it's not too complicated, right? Now, let me tell you a couple more things about this. One is that you can already see, since this is a multiplication, the way to maximize your monthly retirement allowance from a Sarah is to maximize each one of the three factors in the retirement formula. These are the three categories in which you're earning credit toward retirement. You earn credit in the age factor percentage category by getting older. You don't need to really think about that one too much. You just age naturally. And the older you are, the higher the age factor percentages. And I'll talk more about that in just a minute. You maximize this service credit by working longer. You can also purchase additional service credit, which I'll show you in a few minutes. And you maximize this factor, highest average monthly salary, through the course of your career, through cost of living increases, through raises, and perhaps promotions or changing jobs so that you go up into a higher income. And that will maximize this monthly highest average monthly salary part of the equation. So you maximize the monthly retirement allowance by maximizing each one of these three factors. Okay. So let me check the questions real fast. Okay, I'll answer the salary question in a few minutes. And I'll answer the second salary question in a few minutes when I talk about highest average monthly salary. Okay, let me tell you about each one of these in more detail, how you earn them and how we calculate them. And I think that will help answer your questions about how to really maximize them. So let's talk about the age factor percentage first. Okay, so I gave you the example of you would receive 2% of your highest salary for each year of service, but it's not necessarily going to be 2%. That was just an example. So what percentage of your highest salary would you get for each year of service? Well, it depends on how old you are when you retire. And we're going to use this chart of age factor percentages to determine which number we plug into the formula for you. These are the percentages that come from the state law that Sarah has adopted, or that really the county has adopted for a Sarah. And so to figure out where to look in this chart for you, you just look at your tier and you just look at that one column, that one set of age factor percentages, and you don't forget about all the other columns. Okay. So if you're a safety member, a sheriff's deputy or probation officer, you're going to look for your tier over here. Anyone else who's a general member will look for your tier over here. So the way this works is if you're tier four, for example, and a general member, and you retire at age 60, we're going to find out where those intersect 1.80%, and that is the percentage we would plug into the formula for you. You would get 1.80% of your highest salary for each year of service. So you'll notice the older you are when you retire, the higher the age factor percentage up to a maximum for your tier. So if you retire, and that's in the blue boxes, okay, that's the maximum age factor percentage for your tier. So if you retire at that age or older, you get the maximum age factor percentage that you could possibly get for your tier. And so the way that you maximize this is by getting older. It's not, you know, it's not exactly a good way to explain, dialing in your retirement, but you have the dials for service credit and salary are a little bit better than that. But it is based on like one way to do it. When you go to retire, you don't have to understand this now, but the percentages increase with every quarter of your birthday, actually. So you would just make sure to retire, after one of those quarterly age increases. And if there's with the full chart, it would say 52, 52 and a quarter, 52 and a half, 52 and three quarters, 53, and so on and so forth. And there's actually an incremental increase with every quarter year that you age. So if you want to see the full age factor percentage chart, because they don't all fit on this slide, you can check it out on our website. So that's kind of how that works. That's a lot of info to throw at you as a new or mid-career employee. But the bottom line there, if you take one takeaway from the age factor percentage, is that the older retirement age equals a higher age factor percentage up to the maximum for your tier. Okay, and then there's a few questions I'm going to hang on to for a few minutes. There's a tier and age factor percentage question. The question is, why does tier two I guess the question is why are there different percent sets of percentages between tier two and tier four, essentially? And that the percentages you'll note for tier two are slightly higher for each age than for tier four. And the reason for that is because tier four was created during the Public Employees Pension Reform Act of 2012, which was a state law the state passed, and they created tier four. And the idea there was to slightly lower the percentages to give more breathing room to the county retirement systems. And it was essentially to kind of slightly give more breathing room to the taxpayers who are funding the employer contributions, essentially, is what I think was the thinking behind that. But so if you retire at a certain age at tier two, you'll make a slightly higher amount of money than a tier four person who retires at the same age. Having said that, as a consolation, they you the tier four, you can actually get a higher percentage total at age 67, or I think there is a certain age, it might be 66. You'd have to look at the full age factor percentage chart. That you could actually get a slightly, a higher percentage total, and so you could come away with a higher monthly retirement allowance. So that's kind of the difference there. Um, it's state law that determines which tier you went into. These percentages don't change. Whatever tier you went into is going to be your tier. So it doesn't, it doesn't really make a lot of sense to compare yourself to other tiers because you're kind of stuck in your tier, whatever it is. Okay. So we talked about the H factor percentage. Let me tell you about the service credit and how to maximize that number. How do we calculate service credit and how do you earn it? You start earning service credit when you enter Acera on your Acera date of entry, and you're going to earn service credit all the way up to your termination date from your job. You earn, and like I said, it's measured in years, and we calculate it down to the fraction of a day. And you get all of those decimal places you see in your, when you log into your account, you'll get all those decimal places in the formula. So if you work 15 plus years when you at when and retire, you'll see 15 point, 76258. Whatever, all those decimal places, we put it in the formula for you. So you get credit all the way up until your last 15 minutes that you work at your job. You earn service credit during your regular work hours. Okay, that makes sense. But it also, if you think about it, makes sense that you're not penalized for going out on leave. So you do earn service credit during your leave times. You earn vacation leave, you earn sick leave, if you get management leave, if you get comp time, holidays, floating holidays, whenever you mark any of those types of leave on your timesheet, you're already earning service credit during that time. So it doesn't count against you for your Acera service credit. Now, you do not earn any service credit when you go out on leave without pay. You're not earning service credit during that time. Some of that time could be purchasable, though, and I'll show you that in just a minute. Okay, purchase vacation. This is where your employer allows you to purchase extra vacation more than your earned vacation. So let's say you earn 3 weeks of vacation per year, and they'll let you purchase an additional week, so you end up with 4 weeks. Whenever you mark a purchased week of vacation or any purchased vacation time on your timesheet, you're not earning a Acera service credit for that purchased vacation. Okay. Now, having said that, I wouldn't stress out about it. If you need to purchase vacation a week here or there over a long career, I think you'll find that when you sit down and do the math, it's not going to erode your amount of service credit enough to affect your retirement allowance that much. And what it means is that you got to go out on an extra vacation for your mental health while you were working. So I wouldn't sweat that if you have to take a purchase vacation here or there, because vacation is good for you. Okay, this next category, sold vacation. Some of our employers will allow you to take your earned vacation and sell it back to them instead of taking it for extra cash. And that does not, when you make that transaction, that doesn't increase your amount of service credit at all. So you don't get credit for that in the service credit category. Also, overtime, on-call time, or standby time does not count toward a Acera service credit. Now, one kind of the main way of maximizing your service credit is just by working longer. Okay. So you probably, I mean, that's not the most fun thing to hear, but it's just how it works. You work longer and you earn more and more service credit toward retirement. Now, another way to dial in a little bit of additional service credit that will count toward calculating your retirement allowance is to purchase service credit if you have one of these types of eligible time on the list to purchase. Now, you'll notice there is no bullet point here that says airtime or just extra, time. So you can't do that. You can't just purchase extra time. But if you have time that falls into one of these categories, you can purchase that time as a Acera service credit. And the kind of the idea here is that these are types of time where the law did not allow for you to earn service credit during that time, but it does allow for you to go back later and purchase it to increase your amount of service credit in the formula. So here's the list of types of time that is eligible for you to purchase to increase your amount of service credit in the formula. The first is kind of known as ineligible or non-covered service purchase. And what this means is that these types of time were ineligible for you to earn service credit during that time until you got your full-time retirement eligible position. It's kind of time worked before your full-time retirement eligible position, including part-time work that you worked for your employer or one of Acera's 6 participating employers. And this is not none of these, okay, you'll notice none of the categories here are work for a temporary or employment agency or contract work. All that type of time is not purchasable. But if it's time worked for your employer in other categories, including the part-time or seasonal or intermittent service as needed, project work, per diem work. Those categories count, so you can purchase those. Also, the TAP time. TAP stands for the county's temporary assignment pool, um, which is kind of Alameda County's in-house temporary agency. That would be the only type of time like that that would count, and you can buy all that time. Okay, next category. That 2 week lag between your hire date and your entry date is purchasable. Unpaid medical leave. So this is medical leave, unpaid medical leave that you incur during your active membership. So you're actively working, you go out on medical leave. Any time that is unpaid where you're not receiving a paycheck from your employer. So I'm not talking about you go out on medical leave and you're getting paid a paycheck from your employer because you're using your sick leave. You're already getting service credit for that, so you don't need to purchase it. This is any time where you're not getting a paycheck. Um, when you return from that medical leave, you can buy up to a year's worth of that leave per instance. Okay. And when I say return, what basically the qualification for that is that you just come back and get a paycheck. You get paid from your employer. And that's considered returning from medical leave. State disability insurance leave, same deal. If you go out on state disability insurance leave, that leave becomes purchasable when you return from that leave. Military leave during membership. Okay, so this is where you go out on military leave during your active employment. You're out on military leave. You still kind of basically have a job with your employer, and then you return from the military leave. You can purchase that time. Now, this does not include prior military service before you got your full-time retirement eligible position, unless it was, I think, if it was done before 1971, probably nobody here in this webinar falls into that category. And then redeposit. Okay, let me see. A couple of questions popped up here so far. Okay, let me hang on to that question. Okay, let me hang on to that question too. Okay, next category. Deposits of prior memberships. I already mentioned this. Somebody had asked about this, but this is where you used to be an ASERA member in the past. You stopped working for one of our 6 employers. And when you did that, you took a refund of your contribution account. And when that happened, your ASERA membership was canceled and you lost all your service credit from that original membership. Now you're back working here again. What you can do is you can redeposit an equivalent amount of money that you took out and get that original service credit back from that original membership. And that's called a redeposit of a prior membership. Okay, the next category, redeposit of community property. Okay, so California is a community property state, which means if you're married or in a state registered domestic partnership, any retirement credit that you earn while in that relationship is considered community property should that relationship end and you get divorced or dissolve your domestic partnership. Community property gets divided among the ex-spouses or ex-partners. So sometimes people are able to negotiate it where they negotiate away a different part of the community property and keep their ASERA account whole. Oftentimes, what will happen is the way it gets negotiated, the ex-spouse or ex-partner gets to keep part of the ASERA credit, and that is them taking away part of that community property that is ASERA credit. So if they get their own separate account, essentially what happens is they'll take away part of your service credit and then a proportionate amount of your contribution account. Now, they get their own account. If they take a refund of their account, we will let you know about that. We'll send you a letter in the mail telling you your ex-spouse or partner took a refund of their account, and we'll give you the opportunity to redeposit an equivalent amount of money, and you can get that equivalent amount of service credit back to your account, and that's called a redeposit of community property. The final category is other California prior public service. This is where you used to work for another public agency in California, and you're not eligible for their pension with because they will they're using another pension system than Acera. You know, it might be they might use the state's pension system, CalPERS, or they might have their own individual pension system. But you're not eligible for their pension, usually because you didn't work there for very long, or because you worked there for long enough, but you took a refund of your account from and canceled your membership over there. And so if you do take that refund out of that other pension system, we will allow you to buy all of that time or a portion of that time as a Sarah service credit, and that's called an other prior public service purchase. Um, so there's some examples here of different agencies. If you go to acera.org/service, you can see the full list. So those are all of the types of time that are purchasable. If you don't see it on this list, it's not purchasable. Okay, let me see. I think some more questions popped up. Okay, somebody's asking, I should be done with my service credit purchase in the next couple pay periods. Will my Acera automatically update to show the total of my current and purchase service credit, or will you need to do anything else? It will automatically show up. So whenever you're done paying for it, you will see it show up in your online account. And if it doesn't, then contact us. And then somebody's asking, does CalSTRS count toward vesting? And I'm guessing that what you mean is if you made the other California prior public service purchase for CalSTRS time, um, those do not count toward vesting. Okay. Now, what I don't want you to get confused about here is if you have established a reciprocity with another California public retirement system, um, you don't need to purchase that service credit because you already are getting credit for your membership over there. Okay. Or alternatively, if you have done enough time with one of these other employers to be able to collect a pension from their system, even if you have not established reciprocity with the Sarah, you probably want to leave it over there and collect their pension whenever you become eligible for it, because these types of purchases are pretty expensive as opposed to these ones. And I'll show you that in just a minute. In fact, well, yeah, I'll show you. I'll show you. Okay, now what I'll talk about right after this slide is how to make the purchase, how to request the amount, what it's going to cost. Okay, so I'll go through that in just a second. First of all, let me tell you about the times that are not eligible for purchase. Okay, you cannot purchase vacation purchase time back. So remember, this is where you purchased extra vacation on top of your earned vacation, and you go out on that purchased vacation and you don't earn service credit for it, you also cannot purchase it later. Next category. If you're out on leave without pay and it's not medical leave, you cannot purchase that time. Okay, it's only unpaid medical leave. To go back one slide. And let me give you one additional rule that they have. It's unpaid medical leave for your medical condition only, not a family member's medical condition. So one of the things people always ask about is paternity leave. Um, that is for somebody else's medical condition, a family member's, so that is not purchasable later. And that is because the county has not adopted the code section that would allow that to be purchasable. So that would be something to take up with the Board of Supervisors. Okay, next category of time that's not purchasable is any contract or temporary agency time. I already mentioned that. And finally, any other prior public service where you still have the contributions on deposit with the agency. So I'm going to go back one slide real fast. This time, you got to take the refund from that other pension system before we'll allow you to make this service credit purchase. And then somebody's asking, can you buy overtime hours? You cannot, because overtime hours do not show up on this list. Okay, so let me show you how much it's going to cost for you to make that service credit purchase if you have one of these types of time. It's going to cost you whatever your employee contributions had been had you worked at the time. So let's say you're trying to buy 3 months of unpaid medical leave. Okay, so had you been working here for that 3 months of unpaid medical leave, you would have been receiving a paycheck from your employer, and out of each paycheck, Sarah would have taken employee contribution. So whatever you would have had to pay to Sarah during that 3 months is the cost of what it takes to buy that time. And it's depending on whatever your rate of pay was at that time, like whatever the exact dollar amount you would have contributed to Sarah, that's the purchase cost plus interest that that money would have earned had we had it to invest between then and now. So if you're trying to buy 3 months of unpaid medical leave from 5 years ago, had you worked that time and paid that money, contributed that money to a Sarah, we would have invested that money and it would have earned interest for that 5 years. So we will calculate the interest for you, but you're going to have to pay the interest that that money would have earned. And the bottom line there is that the longer you wait to purchase service credit, the more expensive it gets because the more interest that that money would have made had we invested it. So we'll do all this calculation for you, but the time to purchase service credit is as soon as you can. As soon, going back 2 slides, as soon as you incur one of these types of time, go ahead and submit a purchase redeposit request to us to calculate the time and go ahead and make the purchase because you'll be really happy that you did it earlier rather than later. And somebody had asked, what's the deadline for making the service credit purchase? Um, can I purchase service credit from a while ago? Yes, you can. The only deadline for making a service credit purchase is you have to do it by the time you retire. Okay. So let me see. Where was that question? And somebody asked, how does the 2 weeks get calculated? It's the same thing. Whatever your rate of pay was when you first were hired, that's how we calculate that 2 weeks, is whatever you would have had to pay had you had to contribute for that 2 weeks. And then, yeah, somebody asked about the time limit. You got to pay for service credit purchases by the time that you retire, but do it as soon as you can. And then Sarah calculates the interest accrual, how much interest by how much that money would have earned. So we have 2 6-month interest periods per year. And so we calculate our interest that we've earned, based on our investments as of June 30th and December 31st. So every time one of those dates passes and you don't make the service credit purchase, you have to pay that period of interest. And if you want to see what the interest rates are that we have historically earned, what you can do is go to your browser, type in acera.org/interest. It's a shortcut, and it will take you right to our interest rate chart. And we post all of our historical interest rates, I think going back to 1993, that we have earned. And so this column, the second column, that we've actually physically earned during those 6-month interest rate periods. So if you do want to do kind of a ballpark calculation on your own, you could look at your past pay stubs, how much you would have had to contribute to a Sarah had you worked at the time, and then you can, get out a spreadsheet and calculate how much interest that money would have accrued. Now, how do you make the service credit purchase? Well, it's pretty easy. All you do is you complete our purchase request form at acera.org/forms. So you go out to our webpage, acera.org/forms, look for the purchase request form, and fill it out. It's a DocuSign form. You can submit it all online. And what we will do is receive your form. We'll do all the calculations, based on your payroll records and your history that we have on file for you. And we'll send you a letter in the mail telling you how much the service credit purchase is going to cost. And at that point, you can decide if you want to make the service credit purchase and how much. So you don't have to make the service credit purchase just because you send in the redeposit request. That's just to receive the basic calculations. And let me just go back to the list real fast. All of the types of time, except for the redeposits, you can purchase a portion of the time if you choose. Redeposits are all or none. And then you'll notice that all these bullet points count toward vesting. This one doesn't count toward vesting. And also, with all of these top bullet points, you're paying the employee portion of the contributions. For this one down here, you're paying both the employee and employer portion. And so that's why this one will cost a lot more. It'll cost double or triple what these ones would cost. But you can figure all that out whenever you receive that letter from us telling you how much it's going to cost and giving you the different purchase options. And the different purchase options are you can write us a check on a post-tax basis to make the service credit purchase. Or if you have pre-tax funds sitting around in a pre-tax retirement account, including a 401k, 403b, 457b, or IRA, we'll help you roll that over to pay for the cost of purchase. We'll also, if you want, split it up over time and take it directly out of your check through payroll deductions on a post-tax basis, or we'll do any combination of the above. So at that point, when you receive the letter, you contact us and you tell us how much you want to purchase and which method or which combination of methods you choose. Okay, so before I move on to the salary component, let me get back to the other questions about service credit, make sure I answered them. Somebody asked, how would you submit a request to buy medical leave without pay? That would be through making that, um, through doing that purchase request form. And then I think I already answered how does the Sarah calculate the interest accrual? It's based on how much interest that the fund has earned. And then somebody's asking, does the interest continue to accrue? Yes, the interest does continue to accrue. So the longer you wait to purchase service credit, the more expensive it gets. I think the rest of the questions are about salary. Okay, so we talked about the age factor percentage. We talked about the years of service credit. Let me tell you how we calculate the highest average monthly salary. When you go to retire, our software has all your payroll records on file because your employer transmits those to us so we can do these calculations. And our software will find your period of consecutive highest pay anywhere in your career. So somebody asked if you demote at the end of your career and are paid at a lower rate, would your final compensation period be earlier in your career? Yes, it would, because our software is finding your period of highest pay from anywhere in your career. Now, what is and your period of highest pay, or pension lingo, is known as your final compensation period. If you're in tiers 1 and 3, your final compensation period is your highest consecutive 26 biweekly or 12 monthly pay periods, depending on how you're paid. If you're in tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods, depending on how you're paid. So essentially, if you're in tiers 1 and 3, it's your highest year of pay, and tiers 2 and 4 is your highest 3 years of pay. So somebody asked, is it true you have to have the salary for at least 3 years? Well, if you're in tiers 2 and 4, we're gonna use your highest 3 years of pay. If you didn't quite work here for 3 years, there is a calculation that we would do, I think, based on your rate of pay that would make it to the equivalent of 3 years of full-time pay because these are the equivalent of 3 years of pay and the equivalent of 1 year of pay and the highest pay. So another example is if you work 6 years half time, for example, at the end of your career and you're in tiers 2 or 4, and you're making your highest rate of pay, our software is going to add enough pay periods together to make it the equivalent of 3 full-time years of highest pay. So working less than full-time doesn't count against you when we calculate your salary. Okay. So what we do, what our goal for the calculation is to find your highest average monthly salary to plug into the formula. Our software will take your highest pay over that year or 3 years and take an average. So for the year, the highest year, we'll divide it by 12 months. For the highest 3 years, we'll divide it by 36 months to get your highest average monthly salary over your final compensation period, whether it's 1 or 3 years. And this is the number we plug into the formula for you whenever we calculate retirement. And it's all gross pay before any deductions are taken out, if you're curious about that. And so what types of pay are included in this calculation? Well, there's 4 types of pay that can be included in the calculation. The base pay is always included. Okay, that one makes sense. And that will make up the preponderance of your highest average salary calculation. Now, there are some other types of pay that people receive. Someone mentioned out of class pay. There are other pay codes. that you will see on your paycheck. Okay. Sometimes these are called footnotes, but these are other pay codes that you'll see on your paycheck. Now, to answer your question, some of these will be included and some of them won't. And I can't tell you off the top of my head whether that out of class pay is included or any of the other ones because there's like 1,000 different pay codes. But you can find out for yourself. If you go to acera.org/paycodes, there's a PDF for your employer that has all the pay codes on it. You look for that, go over, look for your tier, and it'll say yes or no whether that particular pay code will be included in this highest average salary calculation. The one pay code I know that never counts is overtime. Okay. And somebody asked originally, how long do you have to hold the highest salary for them to use the highest salary? So it's not about holding a certain salary over a particular time. It's that our software finds your absolute highest consecutive pay periods for this calculation. So if you get a raise or a cost of living increase during that time, it would make your total pay go up and your highest average monthly salary go up over that time. Somebody asked, what's the name of the form for service purchase? It is called the purchase under sarah.org/forms. It is called the purchase request form, I believe. Purchase request form right here. And you can see that there's a DocuSign form. You can do it all electronically. Somebody and a couple of people are asking about the tier 4 salary cap. Let me talk about that in just a few minutes. Okay. So the other two types of pay that can go into this highest average salary calculation are vacation sales and vacation cash out that are made during that final compensation period. Only for tier 1 and tier 2 people. Tier 3 and tier 4 people, this is tier 4, it's disallowed by the law, and tier 3, your employer doesn't allow you to sell vacation, so you can't. None of the vacation sales or cash out can be included. For tier 1 and 2 people, if you do sell vacation back to your employer during that final compensation period, or vacation is cashed out for you at the end of your career because you still have vacation left over on the books, some of that could be included. Now, if you want more information about that, go to acera.org/vacation, and there is a full explanation of that on the website. I don't take a deep dive into that topic in this seminar because you don't really need to know about that until you get close to retirement. I do take a deep dive into that in the pre-retirement webinar. If you do want to watch a video about that, go out to acera.org, scroll down to webinars and seminars, click on pre-retirement webinar. The YouTube video will pop open, and just fast forward to the YouTube video until you see this slide, the same slide, and then I talk about that at length. Okay, so a couple of people are asking about somebody saying I'm muted. It looks like from my end, my audio is still working. So maybe your something happened on your device. Can you all still hear me? Okay, so somebody else is saying that they're hearing me. So let me go ahead and thanks. So let me just type that out for you. I think your speakers are muted. Okay, thanks everyone for saying that you can hear me. I appreciate that. Okay, for tier 4 people, one of the parts of the law that created tier 4 in 2012 that took effect on January 1st, 2013 was to also create a cap on the amount of annual salary dollars Sarah is allowed to include for the purposes of calculating your highest average monthly salary. So it's good to be aware of that, going into this. The cap is based on the Social Security wage index limit that Social Security publishes every year. So for 2025, it's $155,000 and $81 for general. For safety members, $186,096. Okay. If you make a higher salary than that per year, what that means is when a Sarah goes to calculate your retirement, we can't include any more than the annual dollars of that salary in your highest average monthly salary. So essentially for that year, that would be your amount of salary, total salary we would use to get your average. Um, so sorry about that's the way the law works for that. That's kind of the bad news. The good news is that the way it physically works is that if you make a higher salary than this, at the time of the year that you have already maxed out your Acera salary, we will stop taking retirement contributions out of your paycheck for the rest of the year until January 1st. And that gives you more dollars in your paycheck to save in maybe your 457B plan or your personal savings. So that's how you can kind of, work around that. There's more information about that at acera.org/limits. Okay, here's the whole, actually, let me make sure I answered your questions on that. Yes, so I think I answered everyone's question on that. So here's the whole thing put together. Here's an example of us calculating an Acera retirement allowance at the time of retirement. So this is a Tier 4 member. They're age 65, and they have retired after earning 25 exact years of service credit. Okay. So based on them being a Tier 4 and age 65, the age factor percentage from the chart would be 2.30%. They have earned exactly 25 years of service, so that's why all the decimal places are zeros. And then their salary in this example was $6,000 per month, their highest average monthly salary. So when we multiply those three things together, that gives us a monthly retirement allowance of $3,450. They get that every month for the rest of their life, plus cost of living increases. Now, one more thing to note is you can take the age factor percentage, multiply it by the years of service, and that tells you what percent of your highest salary that your monthly retirement allowance is. This $3,450 is 57.5% of this $6,000. That means they're achieving 57.5% salary replacement from their Acera pension alone. They're replacing 57.5% of their working salary with their Acera pension, which is really good. That will get them really near that 80% trajectory, which I'll talk about a little bit later. And somebody's asking, is the calculation net or gross? It's gross pay before any deductions are taken out. Okay, so let me help you get now that, oh, you're welcome. Now that we've talked about in general how we calculate your retirement allowance, how we determine each one of those three factors in the formula, how to maximize each one of those numbers by retiring at an older age for the age factor percentage, by earning more service credit and or and additionally possibly purchasing additional service credit if you can to maximize the service credit number. Or for the salary number, you maximize that by making higher and higher salaries through cost of living increases, raises, promotions, or changing jobs. That's how to maximize all of those numbers. So that's kind of, in general, how to do all that stuff. How do you personally get a peek into the future and see what your exact, precise estimate of your future pension is from Acera? Okay, it's pretty easy. All you do is you go out to acera.org. You log into your account, press the login button, sign in. And I've already mentioned, if you don't already have enrollment PIN to enroll in Member Direct, which is the name of our member portal, you're going to have to request a PIN, wait for us to send it to you in the mail, and then you can get in here. Okay, so once you get in here, you're going to click on Estimate a Benefit. This is our benefit estimate tool. And you're going to see this screen here where you can plug in some numbers. And I'll just zoom in here so you can see it a little bit better. You're going to plug in a couple of dates. The first date is your estimated separation date from your employer. This would be your last day on payroll. The second date is your estimated retirement date. This is when your payments would begin. Okay. Now, you're a new employee. or you're in the middle of your career, which is why you're in this webinar. You're and it's asking you for exact dates, okay? Well, you may not know the exact dates, but all you need to do is think of a plausible retirement scenario in the future that you want to get an estimate for. So let's say this is 2025. Let's say you want to see what happens if you were to retire 10 years in the future, okay? And you're thinking, okay, what happens if I work straight into retirement 10 years into the future? Well, it's 2025. You just pick a couple of dates 10 years from now in 2035. And these would just be consecutive dates. Okay. So the payments begin date has to be at least the next day after the separation date. And run the estimate based on that. Now, let's say that you want to see what happens if you stop working 10 years from now, but defer your retirement another 5 years. Well, the separation date would be in 2035, but then the payments begin date would be in 2040. Okay, so you can do those scenarios in here. It allows you to do that. For the beneficiary info, if you've designated a beneficiary with a Sarah, you may see their info pre-populated here. Just make sure the date of birth is correct, because some of them are not, and if it's not correct, it'll throw off the calculations. And then if you don't see your beneficiary info in here, you can type it in. I recommend going ahead and um, leaving all of these blank unless you have a pending purchase contract amount where you're paying a monthly amount out of your payroll and you want to see the inclusion of that, you could go ahead and check that box. Okay, then hit generate. And what you will end up with is this PDF retirement benefit estimate. So you save this to your device, and this is a record of what we're projecting that you will receive in the scenario based on the numbers that you typed in. This is what we're projecting you'll receive on those dates for the rest of your life from Acera in monthly pension payments. And page 2 is some info about your average salary date range that it's using to make this salary estimate. So it's telling you how much average salary it's calculating. It's also calculating your years of service credit in this scenario, assuming that you work full time or continue working at your same rate of time up that you're currently working now up until that date. And gives you some other info. And just to zoom in on page 1, the chart of your estimated monthly benefit, it gives you information about your estimated monthly benefit for the rest of your life for the different retirement options that you get to select from at the time of retirement. Now, for right now, if you're a new employee or you're mid-career and you're not anywhere near your retirement yet, I would just go by this number right here because the unmodified option pays the most to you, the re retiree, of any of the other options, and this is the one that the vast majority of people select. Now, when it gets closer to the time of your retirement, then you might want to start understanding what these other options do. We have information on that on our website, um, and that would be the time when you would start choosing a lesser option. But the unmodified option is what most people choose, so this is what I would go by for now. Okay, let me see if there's any questions about this. Okay, somebody's asking a bunch of questions about kind of the different options regarding how your Acera pension is determined if you leave before the eligible retirement age. I'll definitely talk about that in the second half of the presentation. Okay, somebody is asking about if I retire after 67 years, and I think that you're choosing the number 67 because you're a tier 4 member. And 67 is when the age factor percentages max out. So if you age above 67 and you're tier 4, a general member, your age factor percentages don't increase. You just get the maximum 2.5%. And you're asking if I retire at age 70, which is 3 years after my age factor percentage maxed out, Basically what numbers will I get? Will the years of service continue to go up? Will the salary continue to increase based on cost of living increases and raises and stuff? And the answer is yes. If you retired at age 67 as a tier four, this would say 2.50%. Okay. But then let's say 67 was the same example. Well, you would have earned 2 more years. Actually, okay, let's say that the initial example is tier four, age 67, after earning 25 years of service credit. Well, it would be 2.50% times 25 years times the salary. Okay. At age 70, if you retired at age 70, it would still be 2.50% because you've already maxed out the age factor percentage, but you would have 3 more years of service credit in here. So it would be 28 years. And then your salary would be higher, probably because of cost of living increases and other factors. So, yes, your salary after you max out the age factor percentage, your years of service will continue to go up, and we will use the salary from later periods in your career. You're welcome. And there's one more question. Okay, let me address that question a little bit later, both of those questions. Okay, so that's how you get a precision retirement benefit estimate from Acera. Okay, let me do this one last topic because this one's actually pretty fast, and then we'll take a little 5-minute break. Let me help you understand your retirement eligibility. When do you physically become eligible to retire from Acera? Okay, so we're talking about this date right here in the pension milestone chart. It's through some combination of your years of service and age. And there are different combinations that get you to retirement eligibility. So I'll show you one slide for tiers one, two, and three first, and then I'll show you the tier four slide second, because the combinations are slightly different. So if you're in tiers one, two, and three, you have three different combinations that get you to retirement eligibility. Combination number one is that you're at least age 50. You have at least 5 years of service credit that you've earned with Acera. That includes reciprocal service credit if you have reciprocity, and you have at least 10 years of membership. Looks like my camera changed, or I'm not on camera anymore. That's strange. There we go. Okay, so tiers one, two, and three, they all closed at least 10 years ago, over 10 years ago. So you all in tiers one, two, and three already have 10 years of membership. So don't worry about that. So all you think about it as is being over age 50 and having at least 5 years of service credit, and that's the minimum you need to be eligible to retire in tiers one, two, and three. Now you have other options. Option two is that if you're a general member and you have at least 30 years of service credit, or a safety member and you have at least 20 years of service credit, you can retire at any age, even if it's younger than age 50. Or option number three is that you can retire at age 70 with any amount of service credit, even if it's less than the 5 years that you needed under option one. So if you had 4 years of service credit and you stopped working, you could wait until age 70 and draw a lifetime pension from Acera based on the 4 years that you earned, even though it's under the 5 years that you need for option number one. Okay, so that's tiers one, two, and three. Tier four, you have two different combinations that get you to retirement eligibility. Option number one is that you're a general member and you're at least age 52, or a safety member and you're at least age 50, and you have 5 years of service credit with Acera or combined among reciprocal agencies. You can retire from Acera at that age. So you can actually retire fairly young, like relatively young, based on your service credit amount that you've earned so far. Option number two is that you can retire at age 70 with any amount of service credit, even if it's less than the 5 years. Okay. So somebody was asking if we leave the county before the eligible retirement age, are we not eligible for a pension? Well, you're not eligible yet. Okay. So if were a tier four member, a general member, and you left your job younger than 52, you can still maintain your SARE membership. Um, and if you had over 5 years of service credit, all you need to do is leave your contributions on deposit with Acera, wait till you turn 52, and then you can draw that lifetime pension based on that years of Acera service credit. Okay. I'll talk about that when I talk about career planning options. But that would be an option is you just aren't allowed to draw a pension yet, but once you hit the age, you can start drawing the lifetime pension. And then you're asking, are there such things as a partial pension? Well, it's all every pension, every lifetime pension that you get from a Sarah, you could think about it like one way to imagine it is it's a partial pension of something, a larger pension that you could have made had you worked longer. But I don't think that's a helpful way to think about it. I think it's what's most helpful is just to think about the pension that you're eligible for based on the three factors, based on how much credits that you've earned at a certain period of time. And you just do that by going into your account on our website, using that benefit estimator and getting different pension estimates for different amounts of time that you would have worked with a Sarah. Somebody's asking, does membership include any past Sarah years that one buys back? So if you buy back 5 years from 15 years ago, then you'd be at your year six when you start again now after your year one. Well, if you're asking about the membership years for this option, um, this is basically years transpired between your Sarah date of entry and now. And like I said, if you're in tiers one, two, and three, you all already have over 10 years of membership. So don't even worry about years of membership. And this is the only one of the options on either slide that matters for. So I wouldn't worry about years of membership. What you want to think about is years of service credit. You have to be over the minimum years of service credit, in the different combinations. And yes, um, the amount of service credit that you buy is included for the retirement eligibility. And somebody's asking, what's the difference between service credit and membership? Service credit is years worked, years earned with a Sarah. You work for 7 years at your employer, and you earn 7 years in your full-time in your retirement eligible position. You earn 7 years if you worked full time of service credit. Membership years, the only time that membership years ever comes up for anything with a Sarah is in this option number one, and it doesn't matter anymore. So I wouldn't even worry about years of membership with a Sarah. Um, so yeah, service credit is the one that you want to focus on. Let me help you understand some additional benefits. Acera, in addition to the guaranteed benefits, offers a set of additional benefits, including medical, dental, vision, and other non-guaranteed benefits. There's also disability, retirement, and death benefits, and those are kind of under the heading sort of guaranteed benefits in a way. Excuse me, it's just the medical, dental, vision are non-guaranteed benefits. Disability retirement is if you ever become permanently disabled and you can no longer perform your job duties, you can apply for disability retirement. And there's a whole separate process for that. There's more information about that on our website at acera.org/disability. Death benefits I will talk about. Let me talk about the medical, dental, vision benefits real fast. Now, I'm not gonna go into detail about this, but there's one thing that I do want you to know about this at this moment. Okay. So the medical, dental, vision, Medicare, and other subsidies are extra benefits that Acera offers because the county back in the 80s started a reserve fund to pay for these extra benefits that they thought their retired employees would need. And Acera's Board of Retirement administers these benefits, but they set the benefit levels and they might reduce or eliminate the benefits to make sure that this fund stays sustainable because they want to keep offering this type of benefits way into the future. Now, the fund this reserve fund that pays for these has over $1 billion in it, so it's very sustainable at this point. Um, But there, we do offer these extra medical subsidies. MMA stands for monthly medical allowance, which is the name of our medical subsidy. There's three levels of that, depending on how many years of a Sarah service credit you have. Dental vision is paid for 100% for you. Medicare subsidy helps you offset the cost of being enrolled in Medicare once you get there. And there's an extra supplemental cost of living adjustment that helps you maintain your buying power. So I just want you to know that these exist. And the reason I want you to know they exist is because of this column right here. There's a certain number of years of a Sarah service credit you need to qualify for these. This is part of the Board of Retirement's rules for ensuring this fund sustainability. And you'll note that the healthcare benefits start with 10 years of a Sarah service credit. No reciprocal service credit is included here, okay? But service purchase is included. So a Sarah service credit, you need at least 10 years. And then if you hit the 15-year mark or the 20-year mark, you could get a higher level of the medical subsidy. Okay. The reason I'm telling you this now is this helps you with your career planning because let's say that you've been here for 9.5 years and you're thinking about going and doing something else and leaving with your just your 9.5 years of service credit. Well, you may not want to do that. You may want to stick it out another 6 months, get over the 10-year mark because this extra money will represent a lot of additional money to pay for your life in retirement. So, which is why I like to go back to the pension milestone chart and actually add a healthcare subsidies begins milestone on here for 10 years of a Sarah service credit. So it's just something to be cognizant of when you're planning out your career. Somebody's asking, will this training go over deferred compensation? Yes. In fact, we'll talk about it for 45 minutes starting at 11:15. Okay. So that's basically all I want to tell you about the healthcare subsidies. Um, and then somebody's asking to clarify, buying back service credits from the past counts toward these years of calculations. Yes. The category here is a Sarah service credit. So if you buy service credit with a Sarah, it counts as a Sarah service credit, even though it's purchased. And that would get you over the 10, 15, or 20-year mark for these subsidies. And somebody's asking, does the medical dental vision benefits only work in California or outside of California too? Outside of California also. If you want more information about what they are currently, I recommend going to acera.org/guide, and you can read our current enrollment guide for our current benefits. Okay, somebody's asking, let's see, to confirm for a tier 2 employee, for someone who moves out of state prior to their official retirement age, as long as they have met their membership years and service in option number 1, they could just leave their account alone until they turn age 50. And so I'm assuming that you're a person who is in tier 2 or tier 3 or tier 1. You could just leave your account alone until you turn age 50, and then at age 50, you could request to start receiving your Sarah retirement benefit even though you haven't worked for the county for many years and are now living out of state. Absolutely. You're still an ASERA member. You get to collect on the retirement that you've earned as long as you get over the 5-year mark for age 50. Or if you're a tier 4 member who's safety under option number 1, as long as you get over that, you're age 50 or 52 for general, as long as you got the 5 years, it doesn't matter where you move. You could move to um, Argentina or Thailand or, we don't care. We're gonna pay you your Sarah retirement allowance for the rest of your life. And it would be calculated based on your salary and service credit when you leave. It would be calculated based on your salary and service credit when you stop working, but it would be calculated on your age at retirement. So your age factor is the only one of the 3 factors that continues to increase after you stop working and don't retire yet. Somebody's asking if I retire at age 55 and then decide to come back at age 60. Let me talk about that in a little bit when I talk about career planning. Okay, so regarding extra benefits, and specifically regarding death benefits, let me talk about the death benefits and helping you designate your beneficiary or beneficiaries for death benefits and keeping them current. Let me define a term. A beneficiary is someone who gets benefits. Your ASERA beneficiary is the person you designate to get your ASERA death benefits upon your death. Okay. So all members should have designated a beneficiary, and if you haven't yet, I'll show you how to do that in just a minute. Okay, so let's say this whole category I'm talking about are death benefits before retirement, because there's a different set of death benefits available to you, different but similar set of death benefits available to you after to your beneficiaries after retirement. So this is this is a new employee mid-career webinar. I'm only telling you about your death benefits should you die before retirement. And then I talk about the death benefits after retirement in the pre-retirement webinar. So, but if you're curious, we list them all out on our death benefits page, which is acera.org/death. Okay. So death benefits before retirement. So let's say you're an active member with Acera, which means you currently have a job with one of our 6 participating employers. Okay. But let's say that you're not yet vested. Well, and you die. What would your beneficiaries receive? They would receive a return of your contribution account, which is all of your employee contributions and interest that we've posted there. We would give that all back to them. Plus, 1 month of salary for each year of service that you have already earned with Acera up to 6 months worth of salary. So if you've been working here for 4 years and you die, they would get 4 months worth of your salary in addition to the return of the contributions and interest. Now, let's say that you've already now let's say that you have gotten past the 5 years needed to be vested with Acera. You die. And this is still the example where you have an active job with one of Acera's 6 participating employers. So you're an Acera active member. Well, your beneficiaries would receive an option of 3 different death benefits, options 1, 2, and 3. Option 1 is the same as if you were not vested. It's a return of the contribution account plus the 1 month of salary for each year of service up to 6 months. Option number 2 is a monthly survivor's allowance to a qualified beneficiary, which is spouse, state registered domestic partner, Alameda County domestic partner, or minor children. Okay. Now, before you think, well, why can't I leave it to somebody else? You can. That's on the next slide. Let me show you that in just a minute. But hang on to that thought for now. Option number 3 is a hybrid of options 1 and 2. There is a lump sum that is paid out of the 1 month of salary for each year of service up to 6 months, and then a reduced survivor's allowance. Okay. This is also to spouse, domestic partner, and minor children. Okay. But you can forget about the qualified beneficiary thing because Acera's Board of Retirement about a year ago implemented this new way of providing the maximum benefit to your beneficiaries and allowing you to name any beneficiary for a lifetime retirement or a lifetime survivor's allowance. The survivor's allowance and continuance is essentially, kind of synonyms for the same thing. Okay, which is a monthly payment for the rest of their life. The only thing that you need to do to make this advanced death benefit election is to complete our beneficiary designation form and check the box for the advanced death benefit election saying that you want your beneficiaries to have this. There's no downside to making that election. And if you do that, now any beneficiary, it doesn't have to be minor children, it doesn't have to be a spouse or domestic partner, anyone you name can receive a monthly survivor's allowance for the rest of their life. Yes, to the question from much earlier, you can split the beneficiary payments between multiple people, okay? So you can name multiple people who are not minor children or multiple people, anyone else for this lifetime survivor's allowance. And once you make the advanced death benefit election, you can name any, it maximizes the allowance. So it would be more than had you not made, going back to the previous slide, had you not made the election. Okay. So all you need to do to make sure that this is in place, you can read more information about it at acera.org/ADV. That's the page that has the information on it. But all you need to do is go out to your browser, Type in acera.org/BEN. It's a shortcut to a PDF of our beneficiary designation form. Okay. You save the form to your device. You complete all the fields. You complete them all electronically, except for the signature. So you're gonna have to print it out and sign it for the signature. But then there's instructions on the last page. It tells you 5 different options for submitting the form. Okay. All you need to do is make sure on, I think it's on page 4, you check the advanced death benefit election box. In fact, I'm gonna take you on a little trip over to our website and actually show you. Actually, let me just do it the shortcut way. Sarah.org/BEN. Here's the form. You fill out all your info. You fill out all your beneficiaries info. You can name contingent beneficiaries. And then on section 4, you check this box. That's all you need to do. Okay, you fill out the rest. There's if you have a spouse, your spouse is going to need to sign. Okay, you print it out, and then you follow. You put the signatures on, and then you have one of these 5 options to submit it. That's all you need to do, and you have made the advanced death benefit election to maximize, make sure that your family members are taken care of. All active members should do this if you haven't done it already. If you don't remember whether you've done it already, just fill out the form again. Okay. Nothing in your account when you log in tells you whether you've actually checked that box or not, which is something that we're going to fix in the future, but we haven't gotten to that yet. But every active member should do this. There's no downside, and it ensures that you are leaving the maximum benefits to your beneficiaries. Somebody's asking, can you split the beneficiary payments between 3 minor children using the advanced death benefit election? Absolutely. In fact, there's 3 sets of fields on the form, and you just say you just split the percentage. So you tell us on there what percent you want split between the children, and then so you could do it, like 33 and a third for each one. Somebody's asking if you're vested in a general position with tier 4 and you switch to a safety position, how long do you have to be in the safety position for the safety tiers to apply? Well, on the first minute of your safety work, your safety membership, that's when you start earning credit in like the safety position. And so for you, what we really do in our database is we kind of have two separate sides for you. We have the general side and the safety side, and we'll have all the service credit you're in your general position in that one area, and all the service credit that you then start earning in the safety position in the other area. And when you go to retire, we're going to do 2 calculations for you. We're going to do a general calculation based on your service credit and age factor percentage in the safety tier, and we're going to do a calculation based on your age factor percentage and service credit in the safety tier. The salary will be the same for both calculations. And then we do the 2 calculations. We combine the dollar amounts that come out of the calculations and send you one check. That's how that works. Okay, so now that I've gotten that out of the way regarding active member death benefits and making sure that you do the advanced death equity benefit election. What is it called? Advanced death benefit election. What happens if you have not yet retired yet? So you die before retirement, but you're not currently an active member, you're a deferred member. Well, your beneficiaries would receive a return of a refund of your contribution account. More info at acera.org/death. Also, keep your beneficiary designations current. That beneficiary designation form at acera.org/BEN, you can fill that out as many times as you need to update your beneficiaries. Just always remember to check the box for the advanced death benefit election, and every new form you receive supersedes all the other beneficiary designation forms. Additionally, one more thing about that is that if you've designated beneficiaries For other things like your deferred compensation account or anything to do with your employer, that does not transfer over to Acera. You would designate your Acera beneficiaries on our Acera beneficiary designation form. Also, it's good to check your beneficiaries. Acera.org/login, log into your account, go to beneficiaries. Um, you can see who your beneficiaries currently are designated as. And if that information is old, if you see your spouse from three spouses ago, you're probably going to want to go ahead and redesignate your beneficiary so we don't pay the wrong person should you die before retirement. And then somebody asked if I'm a new employee and haven't completed the Acera welcome form yet. Do I need to do this before completing the do I need to do this before completing the beneficiary designation form? Good question, because it takes about 7 weeks for us to send you. Once you're brand new, it takes about 7 weeks to send the letter to you for you to be in our system for you to complete the Acera welcome form. So I would say wait for the Acera welcome form. You could probably do the beneficiary designation form early if you want to. I mean, it's not, it won't hurt. But if you've already received the letter from us, go ahead, just do it on the Acera welcome form, because the advanced death benefit election is on the Acera welcome form. The Acera welcome form, somebody's asking, it's the when you're brand new, it's the form that we now ask you to fill out to establish your membership with Acera. And you after 7 weeks goes by, when you start your new job, you receive a letter from us that gives you all the instructions on how to complete that. And somebody's saying, how can I see if I selected the advanced death benefit if I completed the designation already? We don't really have a way for you to do that yet. So you have two options. You can either ask us, if you contact us at acera.org/contact, you can talk to us over the phone, or you can there's a email contact form there that you can fill out, and we'll tell you whether or not you elected it, or you could just fill the beneficiary designation out again. So sorry, it's not easier. It's not easier to do that. And somebody's asking, how do you access the Acera welcome form? If you go to your browser, type in acera.org/welcome. Got to put the dot in there. /welcome. That's the shortcut to the Acera welcome form. And you'll note that it also has the advance death benefit election there and beneficiary designations. So if you're brand new and you haven't filled this out yet, you would probably want to start there rather than the beneficiary designation form. Somebody's asking, I wish at some point we can enter this directly in rather than as a form. Last time I did this, whoever filled it out had typos on both the name and social security number, so luckily I checked and resubmitted the form. I wish that too. The problem is that there's this spouse signature on this, and DocuSign doesn't allow for the ability basically for the spouse to sign it automatically, to get it like automatically routed. So we have to do it all manually, and but hopefully DocuSign implements that in the future, and then we can do all this stuff electronically. So sorry about that. But it is on our minds all the time, like, when are they going to implement this? And somebody's saying, I'm a new employee, haven't completed the Acera welcome form yet. Do I need to do that before completing the beneficiary designation form? Yeah, just use the Acera welcome form, because the exact same beneficiary designations are on there. Okay, understanding career planning options. When I say career planning options, what do I mean? What I mean is that at some point in the future, you're going to stop working with your employer, whether you go straight into retirement with Acera or not. What are your options regarding your Acera membership when you stop working the job that you're working in for one of Acera's 6 participating employers? Well, there's kind of two options. And then for number 2, there's going to be 3 sub options, okay? So for the 2 options, the 2 main options, the first is to go ahead and retire once you stop working in your job, if you're eligible. And if you do that, you're going to earn service credit right up till basically the time that you retire. We'll convert your sick leave to additional service credit. You can even go work somewhere else if you want, and we're going to consider you an Acera retiree for the rest of your life. and pay you your monthly retirement allowance for the rest of your life. And you can get your Acera retirement at the exact same time as you're working somewhere else. And, that's kind of option number one. Go ahead and retire. Okay, now option number two, you stop working at your job, but you're not ready to retire yet from Acera. Maybe it's because you're not sure if you're going to come back and work for, do more, earn more credit for, at one of Acera's, for work for one of Acera 6 participating employers and earn more credit. Maybe it's because you're not yet old enough to retire. You haven't reached the age requirements. So what are your options should you not retire immediately upon termination? Well, you kind of have three sub options, A, B, and C. Okay. And so what I'm going to do is take this pension milestone chart and make a distance here, make a separation here between you leaving work and not retiring yet, because you don't know what you're doing yet. You have three options. So maybe you're going to retire later, maybe not. Okay. So option A is that you can become a deferred Acera member. And becoming a deferred member simply means that they're no longer working actively with your employer, but you have left your contributions on deposit with Acera. You have not taken a refund of your contribution account, which means that you're still an Acera member because you're a deferred member. Member is in the term deferred member. Additionally, interest will continue to accumulate on your account with no negative interest. And people ask me what I mean by no negative interest because I kind of made that term up. Your Acera contribution account never goes down. If we experience fluctuations in our investments where, we kind of lose money on paper for a period before it goes back up, during that period, we do not take money out of your account. No negative interest. It is a completely safe way to park your money, a place to park your money. And I don't know anywhere that you can park your money that carries zero risk like this. So it's a really good way to really good place to keep your money. Interest continues to accumulate as a deferred member, or you can retire later. So you can stop working, decide, or for whatever reason, not to retire yet, defer your retirement to a later date and retire out of deferred status. Or, sorry about that, you can come back to work and earn more. So somebody had asked that question. If I retire at age 55, let me see. So I had to come back at work at age 60, work another 10 years. Okay, that's kind of a different situation. I'll get to that in just a second. Okay, and somebody's asking about coming back as a retired annuitant. I'll get to that in a second. Okay. Yeah, so you can come back and work and earn more. So let's say that you stop working. You possibly want to come back and earn more credit toward retirement. You could do that. So you stop working here, you go do something else, and then later, maybe a few years down the road, you can come back and establish, get a new job with one of our 6 participating employers and earn more credit toward retirement, kind of pick back up where you left off. As a deferred member, you do not pay contributions into the system. You also do not earn any more service credit. Your membership is kind of on hold. Or you could be refunded at any time. So you're going to see that taking a refund is going to be option C. You could do that. Now, a good reason to defer is you stop working here and you don't know what you want to do yet. You don't know whether you want to take a refund yet, or you don't know whether you want to retire from Acera yet. You don't have to make a decision immediately. You could be refunded later, or you could retire from Acera later. There's more information at acera.org/defer. There's a list of good reasons to become a deferred member. There's a list of not so good reasons to become a deferred member. One of the not so good reasons to become a deferred member is if you are already ready, you're already eligible to retire at the time that you stop working here, and you want to defer because you want your age to get higher so that you get a higher retirement allowance when we calculate it later. I think you'll find that yes, your retirement allowance would be higher if you defer your retirement and wait till a later date. Your monthly payment would be higher, but In the interim, you're missing out on monthly retirement payments because you're already eligible to retire. And I think you'll find when you sit down to do the math that you will never catch up from all that money that you missed out on. The higher retirement allowance from later will not make up for those monthly payments that you're missing out on while you're waiting around as a deferred member for your age to increase. So that's one thing that you'll learn on the deferred page. Okay, so that's option A. Defer. Leave your contributions on deposit with Acera. Okay. Option B for when you stop working at your employer and don't immediately retire is establishing reciprocity with another California retirement system. Establishing reciprocity is where you're linking multiple California public retirement systems together to synergize your membership between them. You can link all the counties in California, many of the California cities, California state jobs, any agency in California that uses CalPERS, which is the state retirement system, to provide retirement benefits to their members. You can link all of those with Acera. There's a full list of at acera.org/reciprocity. And when you link them together, you gain some benefits from this synergy. The service credit that you earn in all the systems that you've linked together is used for the vesting and eligibility retirements. It gets you over the 5-year vesting mark. It gets you past the 5 years you need for retirement eligibility um, between all of the service credit that you have linked together. So, for example, if you work, let's say you're General Tier 4 member, you work over in Contra Costa County for 2 years, you come work in Alameda County for 3 years, and you're over age 52, the 2 and 3 years combined, if you establish reciprocity between the systems, gets you over the 5-year mark to retire. Second benefit is that the highest salary that you earn under any reciprocal system is used by all the systems when they calculate your retirement. So let's say you were earning $20 an hour over in Contra Costa County, and you come over to Acera, you're earning $30 an hour over here. You did some service credit over there, you did some here. When we go to calculate retirement, we're each going to do a separate calculation. They're going to use your age factor percentage and years of service credit over there. We're going to use your age factor percentage and years of service credit over here, but we're both going to use that higher salary amount when we calculate your retirement. So you would earn more over the previous retirement system than you would have had you not established reciprocity because the salary component of the formula will be higher. The third benefit is that it could lower your contribution rate if you come in at an earlier tier, and it could put you in an earlier tier than had you established reciprocity. So there's more information about that at acera.org/reciprocity. To establish reciprocity, all you need to do is 4 things. One is you become a deferred member on any of the systems that you're linking together. So you do not take a refund on any system that you want to link together. Two is that you want to have no more than a 6-month gap between when you leave one job and enter the next job. So as long as you start the next job within 6 months, you can link the systems together and establish reciprocity. Number three, you don't want to have more than 12 weeks of overlapping service. And this is where you're on leave on the first job and you start working the second job while you're like being paid your leave balances on the other one. Just don't have any overlapping service. They'll cash you out for your vacation leave on the first job anyway. Number four, you got to retire from all the systems on the same day to keep reciprocity whole. So that is reciprocity. Let me see if I answered. Can reciprocity be established anytime or is there a deadline? Okay, good question. Reciprocity can be established anytime before retirement. So you would need to establish it before retirement. But that's the only deadline on that. Okay, so let's see. Okay, so we did options A, we did option B. Um, Option C is taking a refund of your contribution account. So if you want to do this, if you stop working here, you can take a refund of your employee contribution account and we'll give you back all your contributions and interest. Okay. Now, if you're taking a lump sum payment, you're just looking for cash, you're probably going to lose a third of your money through taxes and penalties for early withdrawal from a retirement fund. Now, if you don't want to lose any of that money, you don't want to be, liable for taxes at that moment, you can roll over all that money into another type of pre-tax retirement account and we'll help you do that. Okay. It takes 45 or 60 or more days for this refund to happen. So it's not an instantaneous thing, just keep in mind. And basically, what you're saying is I waive all my rights to Acera benefits, cancel my membership. I don't want to retire from Acera. I don't want the lifetime retirement allowance. I don't want access to any of the healthcare subsidies, should I become eligible for them. Just basically, I want to take my money and do what I want with it. Now, you can do that. That is absolutely right. But let me just remind you of one thing, okay? If instead of taking a refund of your contributions and interest, if instead you become a deferred member, you take option A and you wait and retire later from Acera, this is assuming that you have at least the 5 years of service credit and you achieve the age that you need to achieve for the eligibility requirements. You're going to draw a lifetime pension from Acera, and we're already going to give you a refund of your money within that first 3 to 5 years of your Acera retirement. You're already going to get all the money back within the first 3 to 5 years. It'll just happen in monthly payments over the first 3 to 5 years. Everything after that first 3 to 5 years, you're going to get is like gravy for you. You're going to get a lifetime pension, which will be way more money over the course of your life on average than you would have gotten had you taken a refund. So if you are eligible, if you've already gotten the 5 years, um, it in most cases it doesn't make long-term good financial sense to take a refund. But of course, it's up to you. If you sit down and do the math, and you find that this is the thing that you want to do, it's absolutely right. Now, if you don't yet have the 5 years of service and you leave, okay, your option would be to wait until age 70 and draw a lifetime pension, but based on your less than 5 years of Acera service credit, or go ahead and take the refund and like invest that money somewhere else. So I can see an argument for doing that, if you don't yet have the 5 years. But your other option there would be to come back and earn more credit toward retirement to get over the 5 year mark. And then you could retire much earlier and draw the lifetime pension. So that would probably be advisable there. Okay. Now there's this other thing that I want to mention, uh, that we don't have info up on our website yet, is that you could go ahead and retire if you're eligible, which is going back option number one. If you're eligible, you could go ahead and retire. Somebody asked about this. And this is a brand new thing that you can do. You can retire, and then later you can decide to come back to work for one of our 6 participating employers. And we will put your pension on hold, and you will basically start a new membership that you can retire from at any time. And then once you retire from the second membership, we'll calculate the second membership's worth of retirement that you earned, and we'll restart your first one, and then we'll add that together and send you a retirement check. So you do have that option now, and that's brand new. It's brand new within the the last few months. There is another option where you retire, we pay you your lifetime retirement allowance, we start pension payments, and then you come back at what's called a retired annuitant. You got to wait 6 months um, for that, and there's some other restrictions around that. And whoever asked about that, I think the shortcut for that is acera.org/working, and you can read more info about that. Let me make sure that's right. Yeah, acera.org/working, working after retirement. So somebody's asking if I left an agency that uses CalPERS in November of 2022, came back to Acera in December 2022, left my contributions in CalPERS and didn't do anything with it until now, I should be okay establishing reciprocity. Yes. Sounds like you can establish reciprocity if you choose. And so I would write into us if you want to do that. at acera.org/contact. And I think there's a form that you fill out for establishing reciprocity later. Okay, let's talk about making a retirement planning picture. Okay, so you're seeing this slide again. With this discussion, what we're doing, I mean, this kind of brings everything together. What we're doing is we are taking a peek into the future and we're making sure that we get you pointed in the trajectory of having adequate income replacement, at least 80%, replacing your working salary with at least 80% of what it was when you were working with retirement income in these three categories. Your Acera monthly pension and or other pensions, Social Security, and savings and investments. Okay. Now, I have it here as an addition, and you could do it by hand. You could do this by hand if you wanted to. You could get projections for your Acera monthly pension and Social Security, and then add it all up. But what I recommend doing, this makes it way easier, and you can do this in just a few minutes, anytime you want, is using some technology to get these estimates and using technology to get a ballpark amount of additional savings that you might want to save, okay, toward retirement. And you can see whether very easily in just a few minutes whether your Acera monthly pension and Social Security will get you above 80% income replacement, or if at this point you need to save additional money, you need to start saving additional money now. So it's pretty easy to do. Let me show you how to do it. All you need to do is use the Acera benefit estimator in your account and also the Social Security estimator. Okay, so you're going to use these pieces of technology to get a very precise estimate on what Acera is planning on paying you from your Acera monthly pension in the future, and Social Security is planning on paying you in the future from the Social Security system. So what you want to do is start off with some plausible retirement scenario. I'm going to use the idea that this person in this example wants to see what happens if they can retire at age 62 in the future and see if they can get pointed at a trajectory of being able to retire at age 62, so that they can combine the Acera pension with the Social Security at right off the bat. Okay, but you don't have to do it that way. Just you can do this same method and try out different scenarios, retiring at different ages, and see what happens, and you can kind of dial it in that way. Okay, so I'm going to use the example of retiring at age 62. So for the Acera retirement allowance estimate, I'm going to go out to acera.org. I'm going to click the login button, log into my account, go to the benefit estimator, type in a plausible retirement scenario for retiring at age 62. So I'm going to put in a separation date and a retirement date here for retiring at age 62. And then I'm going to hit generate. I'm going to end up with this retirement benefit estimate, and I'm going to use this unmodified amount right here, member monthly benefit. I'm going to take note of that. Okay. You could write it on a scratch piece of paper, or you could, just save that pension estimate on your device. Okay. Then I'm going to do the same thing from Social Security. I'm going to go out to the Social Security website, ssa.gov/estimator, and I'm going to get an estimate from Social Security. Very similar. And when you do that, you'll end up with something like this. It will show you an estimate for retiring at different ages from Social Security and beginning your Social Security payments from the Social Security system. And if, just to define some terms, Social Security is the government's, basically sort of somewhat of a pension system, but it gives you monthly payments for the rest of your life once you start collecting from Social Security because you paid in to the Social Security system for at least 10 years at some point in your lifetime. And so they have their own set of calculations, but they'll give you an estimate like this. Okay, so you save this estimate and you take note of it. And I'm going to use the number that Social Security is estimating that I'm going to collect from them at age 62. Okay. So this is my scenario that I'm doing. So about $2,200 from a Sarah, about $1,700 from Social Security. Okay. So I have used the technology to fill in the first two items in the equation, the Acera pension estimate and the Social Security estimate. So at this point, what I want to do is continue using technology to decide, do I need to save more money toward retirement to get pointed in that trajectory of having at least 80% income replacement? And if so, how much additional do I need to save? So I want to answer those two questions for myself right now because I'm a new employee or I'm in the middle of my career and I have time to figure this out and get pointed in that trajectory. So what I recommend doing, you can Google retirement calculator and it'll like 30 of them will come up. I recommend using one that allows you to punch in the pension estimate and the Social Security estimate and to tell you whether there's a gap and you need to save more. I recommend trying a bunch of them. They'll all give you a little bit different number and you can kind of, get an idea of your trajectory. The Empower Retirement Calculator, if you do sign up for the 457B plan, is probably the most powerful one. I'm not going to show you that one because Gene Hilliard, our pension, or I'm sorry, our deferred comp 457B expert, who I'm going to turn this over to in just a few minutes, will show you that. I'm going to show you the Vanguard calculator. It's pretty easy. Here's a screenshot of it, but I'm just going to go do it live. And we have some links out on our website that make this easy for you. You just go to acera.org. You go under members, go down to planning your future retirement income. This is actually a step-by-step process, and it walks you through exactly what I'm telling you right now. So when you go on your own to sit down and do this, it'll take you a few minutes to go through all the steps, and it'll take you, to log in to get that Acera estimate. It will take you out to the Social Security estimator to get that estimate, and then it will give you some links out to these different calculators in case you want to try them. Okay, so I'm going to link over to the Vanguard calculator. And the reason I'm using this one is, again, it is because it allows me to type in the pension estimate and the Social Security estimate, and it'll show me any gap that I have, whether I need to save more money. So it's going to ask you some questions. It's going to ask you to plug in some numbers. So in this fictional person, let's say this person's 30 years old, and we're going to stick with the 62 example. Okay, so they're 30 years old. They want to see what happens if they retire at age 62. And let's say they make $80,000 a year. Okay. You just plug in whatever you make per year. Okay, then it's going to ask you how much of your income you already save toward retirement. So if it's $500, you plug that in here. If it's 1,000, you plug it in. Let's say it's zero. Let's say you're not saving any money toward retirement, any additional money. That's totally fine. Don't stress out about that. The past is the past. We're just going to focus on the future and getting you in this trajectory. And then it asks you how much you've already saved. Well, let's say that it's zero. You haven't saved anything yet. Totally fine. Okay, this one right here is the amount of income replacement that you want to target. Okay, so it's up to you. Financial planners will tell you you'll need at least 80% income replacement. Gene Hilliard is going to tell you he's going to want you to get pointed in a 100% trajectory just to be safe. So I'll let him talk about that. I'm going to leave it at 80 right now. And then this final number that you plug in here is the expected annual return from that you expect if you were to save additional money in a place that could pay you interest, like in the stock market or in bonds or wherever, or in like your 457B account, how much annual return you might expect from that. I recommend a number between 2% and 7% just to be conservative. I'm gonna go for 7%. That's what Acera expects to earn on our investments. And it all depends on where you're planning on parking your money. If you are parking it in somewhere that can earn interest, like the 457B account, like 6 or 7%, it's a good thing to put in there. Okay, then it will allow you to plug in the estimates that you got from Social Security and from Acera. So it was about 1,700 from Social Security, and I think it was about 2,200. Sorry, 2200 from a Sarah. Then I'm going to hit calculate. Okay. And what you're seeing here is it's calculating over here how much income in retirement it thinks I will need in this scenario. Over here, it's calculating based on what I put in how much it thinks I'm going to have through my pension and through my Social Security. And you can see that there's a gap. This one is bigger than this. It's saying I'm going to need more than I'm going to have. So if that happens when you plug in your numbers, then you have the opportunity to go, okay, that's fine. I have some time. How much more do I need to save? You can come back up here. You can scroll back up. Okay, they changed this. Let's see here. We can do edit results. Okay, there you go. Yeah, edit results, and you can change it. Okay, what happens if I save $1,000 per year? I'm going to recalculate it. Okay, well, now it's added that income from that extra 1,000. Didn't quite get me there. So now I'm going to edit the results again. I'm going to go up to, let's say, 7,000. See what happens. Calculate. Okay, I kind of overshot it a little bit. So what happens if I go to 6,500? And you can just kind of keep adjusting it until the bars are even. Okay, that is about right. I could, further adjust it, but I'll let you do that on your own. But you want to do it when the bars are about right, okay? And so what this is basically saying is that if this were my scenario, if if that's my pension amount and that's my Social Security that I can expect, in order to get that 80% replacement in this scenario, I'm going to need to save an additional $6,500 per year, okay, which is about 8% of my income. Now, that might sound like a lot. How am I going to do that? But I think a good exercise to do is take that money, divide it by 26 pay periods, see how much it would cost you per month, per pay period, $250. Well, that's a little more reasonable. So, what this is telling you is that you may want to consider saving an additional $250 per pay period toward your future retirement. And if you can't do that right now, if you can't take that much of a reduction in your take home pay, do what you can. Maybe you can start with $20. Maybe you can start with $50. What I recommend is just get pointed in a trajectory. Get used to the idea of saving an additional amount of money and then bump it up once you get used to it until you get to that amount that the calculator is telling you per month to save. And then you'll find that you're pointed in the direction of 80% income replacement or whatever percentage your goal is. And you just make adjustments over time. Redo the calculator again. Come back a year or 6 months from now. Do the calculator again. Do all the estimates again. Make sure that you are saving an adequate amount. And I think over time, you'll find that when you make those adjustments over long periods of time, by the time you get to retirement, you will have adequate income replacement to be able to go ahead and retire. And if you dial this in well, I think you'll find that you can retire a lot earlier than you thought. Maybe it's younger than 62, maybe it's 60, maybe it's 58. Maybe you can dial it down to 56 or 54. So you just use these pieces of technology that are available to you. And I think you'll find that you can really dial this in to the point where you can retire a little bit earlier than you thought, um, and retire on your terms rather than what, the situation is telling you that you need to do or what other people are telling you need to do. Okay, so there's other information here about, where you can save your money, about parking your money where over long periods of time you have the potential to earn compound interest, being cautious, doing your own research. Um, I'm going to turn it over to the investment expert because what he's going to tell you to he's going to talk to you about is, okay, so now that you've established that you want to save additional money toward retirement to get pointed in that income replacement target that you want, where do you want to save your money? And one of the best places to do it is a 457B account where you can save on a pre-tax basis um, toward retirement, and you can contribute a lot of money per year toward that. So I'll let you go through the information on your own. This is kind of abbreviated information of what you find on that planning page that I was showing you, sarah.org/planning, planning your future retirement. But I don't want to uh, take away too much more time from the 457B discussion. So I'm going to go ahead and turn it over to Gene Hilliard. Gene, are you there?
I am here, Mike. Can you hear me?
I can hear you. Yep. So I'm going to stop my
Perfect.
share and you can go ahead and share your presentation. And just as Gene is doing this, I want to let you all know that a 457B is a type of account. It's kind of like a 401k. You all have access to it. You're all government employees. It's for government employees, and you can use it to save additional money toward retirement. And Gene is a educator who Alameda County has hired to provide this type of education to you all on the 457B plan. Now, if you are not an employee of Alameda County, if you're one of the employees of one of our other five participating employers, 99% of what he's telling you is still going to apply to you. So I recommend sticking around for this part of the presentation because he's going to talk in detail about how to save additional money in the 457B plan. Okay, Gene, I'm seeing your notes.
Doggone it. I thought I had it together this time. All right, let's see.
It's a roll of the dice.
It sure is. All right, how about that?
Okay, there we go. All right, take it away, Gene.
All right, perfect. Thank you so much. Well, good afternoon or good morning, everyone. My name is Gene Hilliard, Vice President, Financial Advisor of Emerge Financial Group. As Mike mentioned, my firm was hired roughly 15 years ago by the county to provide retirement planning, investment guidance, and education. A little bit about my background: been a licensed financial consultant slash stockbroker for roughly 20 years, helping my clients create wealth, maintain that wealth throughout their lifetime kids and grandkids. And I'm also a retirement counselor. And my goal as a retirement counselor is to help each and every one of you maintain your current lifestyle in retirement. What exactly does that mean? Well, Mike mentioned it earlier. I'm attempting to make sure that you receive 100% of your salary when you retire. Tall order, I recognize, but if you stay with the county any significant amount of time, 20 plus years, you're potentially halfway there. All we have to do is figure out it through your pension, through a Sarah, you're halfway there, you're at 50%. Now it's just a matter of how do I get that other 50%? And you can use, and many Alameda County participants use the deferred comp plan or the 457B plan, they're one and the same, to close that gap. So I'm going to spend most of my time just kind of giving you an overview of the plan. There's a little bit of overlap with what Mike had presented, so I may kind of speed through that in the interest of time. So let's go ahead and get started here. All right. So, the first step in the retirement planning journey is to estimate or at least come up with an idea of what you're going to be doing in retirement and how much could that potentially cost you. So, most people say when they think about retirement, I'm going to travel. And I always ask the question, where are you going? You going to Africa? You going to Brazil? Where are you going? How often are you going to go there? How much is it going to cost you? People also say, I'm going to spend more time with my family or friends. Well, where do your family and friends live? If they're nearby, it may not be as expensive, but if they're on the West Coast, East Coast, or on the East Coast, or in the South somewhere, it could cost you in terms of flights, etc. Are you going to be splitting homes? All right, that means that's a second home. How much is that second home? The cheapest avenue is just spending more quiet time at home, right? But I can almost guarantee you, you're not going to do a whole heck of a lot of that initially when you're retired. Okay, so the key topics. These are the areas where I'm going to hit: retirement income, benefits of saving through the plan, and also how to enroll. Okay, so let's dive into retirement income. Um, Typically, as Mike had mentioned, planners say you need about 70 to 90. Attempting to get you to 100. You're halfway there. Um, But some people say, well, Gene, I just want to get to $200,000 or $500,000 or whatever the case may be. We just need to have some sort of a goal. But most of you are so far away from retirement, you have no idea. So let's kind of shoot for 100. And if we need to settle for 70 or 80, that's fine. Where will your income come from? It's going to come from Social Security. Some of it's going to come from your pension and retirement plans. Some may come from if you have investment property or you have an account that kicks off dividends that pay you interest every month. Some of you may work during retirement. Okay. A lot of angst, kind of changing gears a little bit about Social Security. If you're seriously concerned about Social Security not being there, then at the end of the day, pretend it's not there. That's going to require you to save more. As simple as that. I will say that Social Security will be around. It is one of the few government entitlement programs that's supported on both sides of the aisle. Now, there's some disagreements on what to do with that money, but it is supported. And then there's a number of ways in which you can fix it. Now, we're on a trajectory where, yes, it's going to go bankrupt. But there are two main ways in which you can fix Social Security. Number one, you can raise Social Security taxes. That is potentially problematic for politicians because the last thing you want to do is talk about is raising taxes. That's the quickest way for you to get voted out of office. Not to make this a political discussion, but that's just, it is what it is. And then also, did you know that you only have to pay into Social Security up to a certain amount of your income? And I think it's like 160, 150, somewhere in there. So you can obviously, to raise more money in Social Security, you can raise that cap. Instead of 160, could be 300, 400, 500. That will shore up Social Security. That's just something that's going to take a lot of guts to make happen. But I'm fairly confident, when it's Armageddon, when it's about to go broke, people, politicians will make the choice of, coming up with a way in which to fix it. Okay. So let's talk about the benefits of the plan. Well, number one, it's easy. You don't have to worry about writing a check and sending it into the IRS or sending it into me or to Empower. It comes directly out of your paycheck. It happens automatically. I will say I do agree with this slide that says you really should focus on 10 to 15% of your salary. But if that seems a little, if that's too much, then fine. Do $100, do $200, do $500, do whatever it works. Start somewhere and continue and build on that throughout your career. Okay, here's some highlights. Um, if you're 50 and under, the max you can put in for 2025 is 23.5. If you're 50 and over, you could add an additional 7,500 max. If you're 60 through 63, you can contribute 34,750, and there's also a 3-year catch up where you can put in invest $47,000 a year, provided that you qualify. Now, I know these numbers seem really, really astronomical, especially given the fact that we all live in the San Francisco Bay Area. Cost of living is so expensive. It's very difficult to put that amount of money away. But again, as I said before, don't let these big numbers scare you out of at least putting something into deferred comp. Okay. I was working on a calculator this morning, preparing for this meeting, and I went to this calculator. I pretended this person, similar to what Mike just showed, but I pretended this person had $0 in their account. They decided on average that they were going to invest $500 a paycheck. No, actually, it was $500 a month for the next 30 years. You're going to have over $600,000. And this is assuming a 7% rate of return. So it's doable to really create a significant amount of cash if you stay consistent with contributing. Okay, here's some more highlights. There is no vesting schedule here, so every dollar that you put in deferred comp is yours. You don't have to wait a specific period of time. It's yours. Once you leave county service, have at it. Uh, there are roughly 15 different investments in deferred comp, so you have the option of picking your own funds, or you can use, there's a couple of do it for me portfolios where you tell us And one of them is called Goal Maker. You tell us the what your investor profile is. You tell us when year in which you anticipate retiring, and we'll do the rest. And then lastly, there is managed account platform through Fisher where they can do all the work. They'll pick the funds. They'll tell you how much you to contribute that you should contribute, and they'll manage the whole process at an additional charge, though. Okay. There are two or three different ways that you can add to your deferred comp account, right? You can invest pre-tax, you can invest in the Roth version of deferred comp. It's not a Roth IRA, but it's a Roth 457B, or you can initiate a rollover from your previous employer. Those are kind of the three ways in which you can, and then obviously, money's coming out of your paycheck, pre-tax or Roth or both. Okay, so let's talk about the pre-tax. I'm not going to spend a lot of time here. Typically, the pre-tax version of deferred comp works best if you believe you're going to be in a lower tax bracket when you retire. Makes sense. You defer your taxes today, so you're deferring, you're paying less in taxes, pay them later when you think you're going to be in a lower tax bracket. Quite a few people like the pre-tax version of deferred comp because all things being equal, if you typically get a tax refund, guess what? More than likely, if you invest in the deferred comp pre-tax, that's going to increase your tax refund. Or if you're always owing, putting money in deferred comp pre-tax will probably lower your tax bill. Okay. The other option in which you can invest in deferred comp is the Roth version of deferred comp. This option works best if you believe you're going to be in a higher tax bracket when you retire. So the way it works, money comes out of your paycheck, you pay the taxes now, you avoid having to pay any taxes in the future, provided that you qualify. But again, as I mentioned, works best if you believe you're going to be in a higher tax bracket. Now, I'm sure a question is going to come up. Well, Gene, you're the expert. What tax bracket am I going to be in? And I'm going to tell you, quite frankly, I have no idea. Why is that? Because that's tax code. That's government. I have no idea what the tax code is going to look like in the future, or when you retire, let alone next year or the following year. So there's a couple of options there. Given the fact that you don't know for sure, you can invest in both. As long as you don't exceed the max, you can go pre-tax, you can go with the Roth version of deferred comp. Split it 50-50, whatever works. Reach out to me if you need some assistance in terms of choosing which option that makes sense. And here's a side-by-side comparison of how it works if you invest pre-tax versus the Roth. Pre-tax, your paycheck's going to change for every $100. Your paycheck's going to change by like $70. If you do the Roth, you put $100 in there, $100 is going to come out of your paycheck, or your paycheck's going to change by that amount. But just have comfort in knowing that your growth of your money in the Roth is tax-free. Okay. The other thing that I wanted to bring up is it's always nice. I know I mentioned earlier that you want to invest in the pre-tax version of deferred comp if you believe you're going to be in a higher or a lower tax bracket when you retire. But I'd like for some of you or many of you to at least look at, making sure that your investment portfolio or your retirement income is tax diversified. What do I mean by that? Well, we already know more than likely your Social Security is going to be taxed. Your ACER is definitely going to be taxed. So if you invest pre-tax, that means that bulk of money is going to be taxed as well. But sometimes some people want to offset. Your ACER is taxed, Social Security is taxed. But if you invest Roth version or after tax, then part of your income will be tax-free. So you're kind of creating a tax diversified portfolio. But again, reach out to me if you interested in hearing more about that. Mike talked about compound interest. It's a beautiful thing. If you were to use the rule of 72, figure assuming a 6% rate of return over 12 years, your account will double. And basically, the rule of 72 is just any two numbers multiplied together that equal the number of 70, 72 is what you're looking at in terms of your money doubling. So in this example, 12 years, 6% rate of return, 12 times 6 is 72, your money's going to double. Or say if you want your money to double in 10 years, what sort of rate of return do you need? 10 times 7. You need a 7% rate of return roughly in order for your double or your money to double. So that's assuming in this case we're talking about you not adding to it. This is just stagnant money that you're putting in for 12 years. But your money was going to grow even faster because you're adding to it as we go along. Okay? Let's see. What are we talking about here? You're in charge. You can once you've decided how much you want to contribute to deferred comp, you can use a percent of your salary or you can use a specific dollar amount. The percent of your salary, I think it's like the minimum is 1%, max is 61%. If you're using a dollar amount, the minimum is $20, and then the max uh, for the year, as I mentioned earlier, if you're under 50, is 23.5. I prefer that you use the percent of your salary scenario. Why? Because as you get raises, if you use a percent of your salary, as your salary increases, your contributions to deferred comp is going to automatically increase, right? Versus if you use a dollar amount and you get a raise, you have to remember to go back in to increase it. And I got to tell you, 9 times out of 10, you're going to get used to this extra money and you're not going to do it. It's going to be years before you realize, oh, I should be increasing. So I would prefer for you to use a percent of your salary. Now, if you have a dollar amount in mind, reach out to me. I can help you do the math to turn that specific dollar amount into a percent of salary. So just let me know. Okay. I think I talked about this earlier. What type of investor are you? Are you a do it for me? Help me do it myself. If you want someone, if you want a company to do it for you, Fisher is where you want to go at an additional charge. If you need some assistance, but you're going to take more responsibility of it, Goalmaker is better. That's the one where I told you, you tell us your investor profile, conservative, moderate, aggressive, tell us the year you're going to retire, and then the Goalmaker system will create a portfolio. And then lastly, if you have some experience or you're interested in creating your own portfolio with the core investments in the plan, you could do it yourself. Okay. How do you enroll? Log on to treasurer.acgov.org. So everyone write that down if you're not enrolled in the plan. Treasurer.acgov.org. Go to the deferred comp tab, click on forms, download. You can't, it's not a fillable form, so you're gonna have to print that whole thing out and complete it. All right. So the areas where people get a little tripped up is the whether pre-tax or Roth. Just choose the pre-tax for now. Circle back with me, and I can help you discern which one of those, the Roth or the pre-tax, makes more sense. We can do that later. The other area where people get tripped up is on the investments. I'd say right now, just choose the Alameda County. No, choose the Advisor Goalmaker Moderate 2040 Fund for now. Advisor Goalmaker Moderate 2040 Fund for now, especially if you're 16 plus years out from retirement. Just choose that. You can always, again, come back to me and have a meeting to make sure that's appropriate. If you plan on retiring before 2040, just use the Advisor Goalmaker Moderate, not the conservative, not the aggressive, the one right in the middle. Choose the year in which you plan on retiring. Is it 2035? Is it 2030? Is it 2028? That portfolio will be there. So just check that box. Okay. If you're already in the plan and you want to increase what you're contributing, then you go to the same website, treasurer.acgov.org, and then go to the payroll modification form and then complete it, enter in the percent or the dollar amount you want to change it to. Okay. If you are currently in the plan and you have yet to create a user ID and password for the website, I encourage that. Go to AlamedaCountyDCP.com, click on register, and then you're off and running. If you're not in the plan, you cannot register for the website. You have to have money going in before you can register. So don't even waste your time registering if you're not in the plan. Download the form, complete it, send it in, After your first contribution takes place, then you can register for the website. Okay, real quick, since this is up, where it says meet your plan representatives, look to the bottom, the two men shaking hands. That's where you can go to schedule a phone appointment or a virtual appointment with me and a few of my colleagues that I'm going to bring up later. And here's what I was talking about registering for the plan. If you have a pen or do not have a pen, just follow the prompts. Tons of features. There's just download the app. Um, Mike had mentioned Empower has what is called the retirement income calculator, is similar to that Vanguard website he was describing. The system will kind of give you an idea of if you're truly on track to accomplish your financial planning or retirement planning goals. Telephone number to get in contact with us, 855-969-4572. Or as I mentioned before, go to AlamedaCountyDCP.com to schedule an appointment with either Mark, myself. You can go have a scheduled meeting with Dan or Jose. You can do that again by going on the website or calling this number, 855-969-4572. Hit option, I believe it's 3. Hit option 3 and it will say, to schedule an appointment with Gene, press 1. Mark Tomei, plus 2, et cetera, et cetera. Okay. Let's see. And I think that's all I had planned on sharing with you guys today. I'd love to entertain questions. What is on your mind?
Awesome. Thanks, Gene.
My pleasure.